Hello everyone. Today we are going to discuss an interesting trading strategy, the 15-minute opening range breakout strategy with reversal. This was shared in one of the podcasts recently. ORB itself is not new. Many intraday traders use it. The idea is simple. You wait for the first few minutes of the market, define a range, and then trade the breakout of that range. But in this strategy, there is one additional rule: stop and reverse. Let's first look at simple open range breakout. For BankNifty, market opens at 9:15 am. In this strategy, we take the first 15 minutes of market data. That means the candles from 9:15 to 9:30 am. Because we are using 5-minute data, this includes 3 candles: 9:15 candle, 9:20 candle, and 9:25 candle. From these 3 candles, we calculate two important levels. First, the opening range high, which is the highest high made in the first 15 minutes. Second, the opening range low, which is the lowest low made in the first 15 minutes. These two levels become the battlefield for the day. Once the first 15 minutes are complete, we wait for BankNifty to break either the high or the low. If price breaks above the opening range high, we take a long trade. If price breaks below the opening range low, we take a short trade. Simple. But this strategy has an additional twist. Let's understand this and other rules with an example. After 9:30 am, we start watching the market. If Bank Nifty breaks above the high of the first 15-minute range, we enter a long position. The stop loss for this long trade is the low of the first 15-minute range. In the chart, the first 15-minute high is 54,900 and the first 15-minute low is 54,700. We enter long above 54,900 in the fourth candle. Our stop loss is 54,700. That means our risk is 200 points. Now comes the reversal rule. The long trade fails and Bank Nifty comes down and hits 54,700, we exit the long trade. But we don't stop there. We immediately reverse and enter a short position at 54,700. For this short position, the stop loss becomes the opening range high, which is 54,900. If the short trade works, we hold it till the end of the day. If it fails and goes back above 54,700, we exit the short trade and stop trading for the day. There is no second reversal. This is very important. The strategy allows a maximum of 2 trades in a day. One initial breakout trade and one reverse trade if the initial breakout fails. Now let's look at the short side. If Bank Nifty first breaks below the opening range low, we enter short. The stop loss is the opening range high. If price then goes up and hits the stop loss, we exit the short and immediately reverse into a long trade. The reverse long trade then has stop loss at the opening range low. Again, if that also fails, we exit and do not take any more trades for the day. The final exit is at 3:15 pm. So, if neither the initial trade nor the reverse trade hits the stop loss, we exit the open position at 3:15 pm. This is the complete original strategy. After testing the original strategy, we added one practical filter. We skipped days where the opening range was too small. If the 15-minute opening range is less than or equal to 100 points, we do not trade. Why? Because very small opening ranges can create false breakouts. The price breaks the high, then immediately breaks the low, then again moves up. These are choppy days. In such cases, the stop and reverse logic can become dangerous. So the improved test was: trade only when opening range high minus opening range low is greater than 100 points. Everything else remains the same. Entry is still at the breakout level. Exit is still at stop loss hit or 3:15 pm. Reversal is still allowed once. No candle close confirmation. Now let's come to the backtest. We tested this on approximately 1 year of Bank Nifty 5-minute data. The period was from April 15th, 2025 to May 14th, 2026. Prior results were already shared in the podcast. Let's look at the headline result. The strategy made a total of 3,464.2 points over the test period. If we multiply this by current 30 lot size, 103,926 rupees, in 1 year with average margin of 2 lakhs, more than 50% return in 1 year. Win rate was 53.06%. Now on the surface, this looks good. The strategy is profitable, win rate is slightly above 50%, and the total return is positive. The real question is this profit strong enough to survive real market execution? And that brings us to the biggest villain in intraday trading, slippage. Slippage means the difference between the price you expect and the actual price you get. In this strategy, theoretically, if BankNifty breaks above the opening range high at 54,900, we assume entry at 54,900. But in real trading, you may get 54,905 or 54,910. Similarly, when stop loss hits, the exit may not happen exactly at the stop loss level. This difference may look small, but in intraday strategies, it can destroy the edge. So we tested the strategy with different slippage assumptions. With zero slippage, the strategy made 103,860. With 2-point slippage per execution, it made 62,886. With 5-point slippage per execution, it made only 1,326. And with 10-point slippage per execution, it lost 101,274. Now this is a very important finding. The entire strategy's profit almost disappears with just 5-point slippage per execution. That means the edge is very thin. If you are trading manually, if your order execution is slow, if bid-ask spread is wide, or if stop loss gets skipped during fast moves, then this strategy may not behave like the backtest. This is why execution matters. The logic can be right, but the execution can still kill the result. Now, one argument in favor of this strategy is that because entry and stop loss levels are known in advance, a trader can place limit or stop limit orders near those levels. That may reduce slippage. But reduce does not mean eliminate. In real markets, especially in BankNifty, sharp candles can still create execution gaps. So before trading this live, the first question should be, can I actually execute close to the backtested price? If yes, the strategy may still be worth deeper study. If no, then the backtest profit may be theoretical. Let's talk about drawdown. The strategy made around 103,920, but the maximum drawdown was around 100,050. That means at some point the strategy went through a drawdown almost equal to the total net profit. This is a major point. A trader looking only at total profit may feel confident, but a trader actually trading the system live will experience the drawdown emotionally. Imagine trading a strategy for months and seeing it go down by 3,000 plus points. Will you still continue? Will you reduce quantity? Will you stop at the bottom? That is the real test. Drawdown is not just a number. Drawdown is a psychological pressure test. If a strategy makes 102,000 in a year but also has a 100,000 drawdown, then the return to drawdown ratio is not very comfortable. The strategy is profitable but not smooth. This means position sizing becomes very important. If someone trades too aggressively, the drawdown can force them out before the profitable months arrive. Now let's discuss the point that really caught my attention. A few months contributed most of the profit. In fact, around 3 months contributed roughly 1,40,000. But the total strategy profit was around 1,03,000. What does this mean? It means the remaining months, when added together, were negative. This is very important, because if you only look at the total number, you may think the strategy is consistently profitable. But when you look month by month, the truth may be different. The strategy may be making money in a few strong trending months and losing or staying flat in other months. That is not necessarily bad. Many breakout systems behave like this. Trend following systems often make most of their money in a few big moves. But as a trader, you need to know this in advance. Because if you start trading during the bad months, you may think the strategy is broken. You may stop trading just before the good month arrives. That is why month-wise performance is critical. A strategy should not only be judged by total profit. It should be judged by how many months were profitable, how deep were the losing months, How long was the losing streak? How dependent is the strategy on a few outlier months? In this case, the concentration of profit is a warning sign. It does not mean the strategy is useless. So, what is the final verdict? The strategy is interesting. The rules are simple. The logic is clean. The backtest is positive before costs. But there are three big challenges. First, slippage. At 5 point slippage per execution, almost the entire profit disappears. Second, drawdown. The maximum drawdown is almost as large as the total profit. Third, month-wise concentration. A few months contributed most of the returns while the remaining months were negative overall. So would I blindly trade this strategy? No. Here is the final question for you. If a strategy is profitable on paper, but the profit depends on low slippage, a few strong months, and your ability to survive a large drawdown, would you still trade it? Think about that before putting real money. Comment below to get the backtest file. That's it for today. Thank you for watching. More backtest videos coming soon.